I'm just going to introduce our panel speakers. We're so pleased to have three of our panelists joining us here today. First is Chao from InnoVen Capital, Vinod Murali from Alteria Capital, and Chris Wilson from Simmonds Stewart. Hello, everyone.
Hello.
Hello. All right, so let's just get started. I think we've had quite an interesting year. 2019 was, very much, a lot of capital in the market, a lot of dry powder in the market, lots of money. And then towards the second half of the year, WeWork happened. And then this year, and everyone was kind of expecting like 2020 was going to be, it was going to be a bit of a slowdown. And then COVID just came out of nowhere and just kind of blindsided everyone. I mean, how does a venture debt firm, this question is out to Alteria Capital as well as to InnoVen, Chin and Vinod. How does a venture debt firm like yourselves assess a scenario like this?
I'm going to go first. Okay. So you're right, Christy. So I think towards the end of last year, India, I'll restrict this to India and Chin can talk about Southeast Asia. India has been contracting a little bit. So we were seeing, fundraising was not that easy. And we were coming off a few years of sharp growth. I think start of this calendar year, even without COVID, I think the writing was on the wall that for a lot of Indian companies, it was going to be a difficult year to raise capital. On the flip side, there's a lot of dry powder aimed at India. So there's a lot of venture capital funds who raise capital. And ultimately for venture debt, that's a very important driver. What is the extent of dry powder that is there, which is stable, focused on the specific market. And for India, that's a pretty strong variable even now. So we've been doing this for many years as a team. In Alteria, we've been doing this for 2 years, and we've seen multiple cycles. But there was a period where, the last 18 months, there was a significant uptick in venture debt deal velocity, given the market was expanding a bit and more companies were getting aware of what the product is and, what are the nuances and when it's relevant and when it's not. And there were many, many more data points for founders to take comfort and say, okay, this is where it makes sense for me and this is where it doesn't make sense for me. We can talk some more about that through this conversation as well. But this, once COVID hit, of course, it changed the entire, baseline. And, obviously through kind of a span in the works for everybody, which is definitely the case for venture firms as well. So I think from a pure India perspective, it was already contracting to an extent. But in tough times, I think it becomes easier to pick up good quality. I think there's a natural flight to quality and better deals, more sizable deals happen. In fact, even in 2014-15, just before the election and just after that period in India, we saw kind of a downturn. And in 2013 and 2016, and we saw the same behavior where the good, strong companies, the founders are able to raise more capital and they become easier candidates for venture debt. So we've kind of seen a bit of that in the past as well.
What about you, Chin? I mean, what have you been seeing in Southeast Asia? Was it also the same in the last, I think you mentioned 18 months, right, Vinod, that you saw a pickup in venture debt requests?
Yeah, I think Southeast Asia is, similar trajectory, I think. But I think for our point of view, I mean, for InnoVen, for Southeast Asia, I think we had, sort of our best year in 2019. It was slowly, the venture debt side at least was starting to get more, I would say, well-known among founders and VCs. And so I think we ended up completing around 24 transactions in 2019. And, I think we were expecting a bit of a slowdown, but I think there was enough momentum from all the funds that had raised additional capital that they were looking to deploy that I think it was, I think we were going to have a decent year as well. And I think, then this, the COVID thing came around, and I think, it did change the baseline. I think even in Southeast Asia a lot. So I think it's just been, unfortunate that there's good thing as a dry powder in the ecosystem. So I think that's going to help. And I think, it was just sort of unfortunate timing. I don't think it's ever a good timing to have these things happen. But as Vinod said, I think there's some opportunity here to put, money to work in, sort of category leaders in each of the industry sectors. So I think that's on the opportunity side. On the risk side, I think it's just, we're looking at all the borrowers that we've lent money to and just having to evaluate where they are in their fundraising cycle, how's the business, and sort of managing, expectations going forward.
How has that changed the deployment strategy for the both of you? Like, has COVID at all changed the deployment strategy just because, I don't think anybody anticipated the impact of COVID to in any market actually.
I think, I mean, it has. I think we've set the bar, I think, a little bit higher than we otherwise would, just given the uncertainty of what's going on. But I put things in context a bit. In 2018, we completed 14 transactions, and in 2019, I said we did about 24. So I think this year will be closer to the 2018 numbers that we saw for us, rather than, hit sort of the 2019 numbers.
Same for us. I mean, the bar is definitely much, much higher. I think we're also waiting to understand what is the real post-recovery or post-COVID situation, because right now there's fires being put out. And we're still in a zone where I think it's not fully clear what the path of recovery is going to be, especially in India, where it's a very diverse, complex market, and there's many micro markets. There's industry dynamics, there's geographical market dynamics, and there's this whole community question, what's going to happen on several businesses which rely on kind of a community underlying baseline. So I think that we pushed to a little bit later, and we said, we'll have to figure that out with time. It's a very, very dynamic situation. I think currently the focus is on the existing portfolio. We have a few deals which are, term sheet and docs, so trying to get those closed out. And, we need to wait and watch and see what the scenario looks like post June, where some of the new variables become more clear.
Yeah. What about you, Chris? I mean, you deal with a number of startups as well as funds. What have you been picking up in the last month or so, and what have investors and founders been telling you?
Yeah. So as you say, I'm acting a lot on the company side, which is useful, I think, because it does give sort of a broad overview of the market in some ways. In the short term, I would say there's been an uptick in demand on the company side for this. And I suspect it's because, traditional capital is going to be slightly more difficult to access for some companies. And so they're more open to, other ways of funding, right? Yeah. So certainly something which has been raised more regularly as a potential way to go. And that's great, right? And I think that's also a continuing of a trend, like the other guys have mentioned, right? Which is every year I've been here, there's been more venture debt deals as more providers have turned up and awareness has grown. People understand the concept and where it fits in the ecosystem. So, not surprisingly on the demand side, people still want to raise money. And in fact, it's, a spike in demand because people want to raise now to give themselves some buffers for the next few months, right? So they're quite open to ways of doing that. And I have certainly seen venture debt deals going ahead. So as to say, there's dry powder out there. If you're a high quality company that has a reasonable plan to get through it, it's definitely still possible to access traditional VC capital, to raise notes and to raise venture debt. Of course, and not surprisingly, and we'll probably touch on this a bit more later on, some of the terms changing a little bit, not just in venture debt, but in across the board in VC with a bit more downside protection and valuations and so on. But at a high level, yeah, it's still doable, but it's as Chao and Vinod were saying, right? You have to make a reasonable case for it.
What kind of terms are you talking about?
Okay, sure. Jump ahead. So there's probably going to be more tranching, right, of investments. So you've taken 5 million, maybe you only get a third of that up front, and maybe you've got to hit some targets as you go. There may well be, I'm not speaking specific to InnoVen, by the way, this is just from a variety of sources on particular deals. Or there may be commercial targets and covenants, right? So maximum negative cash flow that you're allowed to hit, asset ratios, or just performance targets in general, which either you have to hit them in order to get your next tranche of funding, or even to trigger a potential repayment of principal and interest, right? So if there's ongoing performance requirements that you may see in some deals, I wouldn't be surprised to see interest rates going up slightly to reflect additional risk. Maybe additional control rights over what the company can do with the money. There's lots of stuff that can happen, and I am seeing it, again, not just in venture debt, but convertible equity. There's a lot more control being put into documents. On the positive side, I have seen a couple of deals where the venture debt is willing to take up a higher proportion of the deal. I believe typically it's closer to a third of venture debt versus standard equity on a round. I've seen a couple where it's like 50-50 now, because if it's a high quality company, they're often doing deals that where access to capital is still slightly limited, so they're actually looking for a higher proportion of venture debt. So there's some flexibility out there, but as is always the case, right, when there's higher risk in the overall business environment, there's going to be some additional control and risk protections built in from the investors' side overall.
Yeah, Chin, earlier you mentioned that you're kind of raising the bar in a sense for potential portfolio companies that you guys want to take on. Can you just kind of take us through a little bit on that? Why do you say you're raising the bar, and in what way are you raising the bar? Like, what exactly are you looking for among potential portfolio companies that you may want to engage with?
And so when I think about that, we're looking, I think, opportunities to put money to work in sort of category, what we think can be category leaders in the space, right? So there are companies out there that we have not had a chance to work with that I think in this environment are looking to shore up their sort of balance sheets. So they're looking for, looking toward us for the first time. And so I think those are deals that we could probably do. When I think about bar, I think venture debt's always been sort of complementary to the venture capital equity that goes in the company. And so we're never going to be the primary source of capital for most of these companies. And so we're going to be looking for companies that have, I think, decent cash runway. So, venture debt's never been sort of the bridge loan type of money. And so we're not going to start that now in this environment. I think cash runway is going to be something that's crucial for us to look at. We're going to look at probably more closely sort of the, equity base and who are the investor syndicates behind these deals. We're going to want to look at sort of financial projections and, what does it look like going forward after, once the economy starts to recover a bit and once we're out of the, lockdowns in the various countries. I think those kind of things we're going to be looking at. I'm not looking so much in terms of the sort of financial terms right now. I think the main issue we're going to probably see, I think soon, we haven't really seen it yet in Southeast Asia, just valuations are going to dip quite a bit. And I think that's going to be a trigger point for a lot of the VCs to start hopefully doing some more deals. And at that point, I think we would then also probably increase our pace a little bit as the rounds get closed. Because what we're seeing is just a lot of companies that are in our pipeline have just remained in our pipeline because the rounds are just not closing as quickly as the companies would hope. And so because we're sort of almost a complementary source of capital, it's very difficult for us to sort of take that kind of risk and just be the lead, sort of take the lead in terms of fundraising for these companies, just given that we are debt and our risk, and our risk reward profile doesn't allow us to take equity type risks.
Yeah. Have you started seeing valuations drop already in Southeast Asia, or is it still early days?
Early days, I think. We haven't seen it quite impact yet. Through our China office, we've started to see that start to happen a bit right now, where we're seeing, valuations, 50% lower than last round valuations in certain cases. So I think you're going to have to start to see that going forward. It just hasn't hit here yet.
Yeah. What about
it? I'd say I probably already have. Not on the venture debt stuff, but you can already see it on I think it flows through, right? So a lot of the seed rounds in Series A, those valuations have taken a slight hit. And of course, there's a lot more companies out there raising rounds now that are either flat, minimal upticks in value, or even down rounds.
These are Southeast Asian companies, Chris? Or?
Yeah. I'm in Singapore, so all my clients are Southeast Asian,
What about in India, Vinod? Has it been the same?
Well, India, from a valuation perspective, a bit early to call. Wherever capital is coming in, I think it's either getting clubbed to the next round where people are not pricing it. It's predominantly inside rounds. I think that's been a trend in the last 6-9 months where, in India, it's a fairly unique situation where the Series Bs and Cs have always not been easy. And a lot of the venture funds have raised much larger corpuses so that they can support their companies through the Bs and Cs as they go along. And the good companies perform well, don't get starved of capital, especially when their performance is not being understood by the market as well. So I think it's a bit early to call on valuation, but I think the clear message is there's going to be pressure and there will be flat rounds and down rounds. I don't think that's the focus right now. I think the focus is how much cash is needed, what is the real runway, how do you even calculate runway in many of these cases when revenue estimates are not very clear. So in India, right this day, I think we are at this point still figuring out what the path of recovery is going to be. Is it 2 months, 6 months, 12 months, 2 months to at least get going, and then 6 months to create a medium-term balance, and maybe 9 to 12 months for eventual recovery. And what does it do to companies, and what kind of levers they have to control burn? How do they expand? Do they contract? So I think the conversation today is more around preserving not just cash, but also figuring out runway and understanding what is the right approach for founders to take, and what are the levers there. And some businesses have a lot of operating leverage, and they are clearly using that already. Some businesses do not have the luxury; they do need more capital. I think those conversations are also happening, and some of them, in fact, raise some more capital. Those are not really getting priced necessarily right now. It's typically either a discount to the next round or an extension of the last round. But I think we are still a month or two away before we can understand what the impact on valuation is in a meaningful sense.
Yeah. Well, what kind of cash runways are you looking at? And I mean, is it difficult to actually find the kind of companies that you're looking for, especially since it wasn't that long ago when the WeWork scandal kind of broke out and people started to have a bit of a reality check, and we just got out of that whole season of growth at all costs. When you're talking about deployment, is it difficult to find the kind of companies that are worthy of I wouldn't say worthy, but suitable for venture?
You're right. It's a fair question. So we look at industry impact, company positioning, leadership versus not, the liquidity they have, and the kind of equity support they have. And an overarching sense of intent on top of all of this. So the capacity is getting tested across multiple parameters, but the key is what is the kind of venture capital support which is visible, what is the kind of liquidity they have. The issue today is if you think about a company and has a runway of 12 months, that has some assumptions around revenue, which I think are still a couple of months away from even being a little bit more certain, at least for India. Right. So I think it's going to take a couple of months before one can say, this is the revenue ramp. And for some of the businesses which are right now at zero, a lot of it is in the air. So which is why we've in fact told our founders that right now just look at what the cost base can become. What are the flexible, where is the flab? Is there any flab? What can you do to protect yourself right now? And we need to wait a bit to understand really what the revenue ramp is. And that will determine what real runway is. Is it 9 months, 12 months, 15 months? Around this, there needs to be a circle of conversations around fresh capital. So today, I think that is happening. A lot of inside round discussions are going on. We are seeing venture capital investors, equity investors kind of stepping up and providing lifelines where the companies are showing that they're not fundamentally broken as a business model. There are some sectors which are far more scrutinized. They are going to take much longer to recover, and those sectors. There's enough literature around that. Yeah. And then there are many which are question marks at this point of time, where the path to recovery is not very clear.
Yeah.
So I think it's too soon to call even on that front.
Yeah.
And from our perspective, we're not in a hurry to kind of write new checks for completely new situations. I think we want to wait and watch a little bit and just understand over the next 60, 90 days what the new dynamic is, what kind of businesses are becoming more relevant and attractive. We're getting some signals, but not a lot of clarity. Yeah. The other big focus is going to be on existing companies. I think that's where there are strong relationships. There's a bedrock, which is very, very strong in pretty much most of these cases, where investors step in and do more for companies. They're already present. I think those are the no-brainers where there is a relationship, it's frictionless, and there's a lot of comfort. It needs to be warranted. There needs to be more capital coming in. I think so we're writing a couple of checks this week, which reflect that, and we are writing checks to newer companies which are already in term sheet, and we're kind of taking that through to closure. But fresh conversations, I think, will take a little bit of time for us to get comfortable with the new normal.
Is it going to be the same for you, Chin?
I think overall, probably very similar. I mean, most of the conversations we've had over the past month or two have been with, existing companies that we've been working with. I think we're trying to close out one transaction this month. We funded some probably 2 months ago. But I think, I think a little bit what's different than I think what India is experiencing is that there have been conversations among sort of the investor syndicates and the VCs about internal rounds, but they are also, I think everyone's sort of taking a wait and see attitude. And I think until those conversations come to more fruition on the equity side, it's very difficult for us to do something just on our own. So we sort of believe in sort of a collective effort to help the startups that we're working with. And it's not just us doing something, it's, the company taking its steps to make sure, as Vinod would put it, cost rationalization to a large extent. So I think the companies are doing their part. They're talking with their customers and also their suppliers to, smoothing out the situation. We would definitely, help in that situation as well. I think the missing piece for us right now is sort of what the equity investors are going to do, and are they going to sort of commit, capital for internal rounds, and then we would, definitely sort of try to participate alongside that. But I think those conversations are still fairly early. It's the uncertainty is probably the one biggest risk here, is that, from week to week things change so quickly. So I think that's the thing that everyone's trying to get their mind around at this point.
Yeah. Chris, you've done a lot of venture debt deals in the past. You've dealt with, a lot of founders as well who have done such deals. Based on your experience, especially here in Southeast Asia, what kind of advice would you give to other founders who are considering pursuing venture debt during this time when there's so much uncertainty? And clearly there's also some caution from the venture debt players themselves.
So I think the point is that it is, as Tim was saying, like quite heavily linked to the VC stuff, right? So if you want to do venture debt, well, the key driver is going to be to get either external capital or to raise money from people on your balance sheet, on your cap table already. And there's certainly been some success with people doing that, particularly more mature companies, because frankly, right, if you've got a larger investor on your cap table who's put 25, 30 mil into the company and you need 5, 10 mil in a bridging round, they're heavily incentivized already to come in and get that to work. Which is exactly what's being said here, right? That's a good driver. If the company is fundamentally sound and someone's heavily invested or pot committed, they're much more likely to give that bridging financing across versus going to external investors who have no risk exposure to that vehicle. You can get them to invest, but they need to be more heavily incentivized, probably with more preferential terms or valuations, etc. So venture debt can still be a really, really useful tool at the moment, because even people who are on your balance sheet, whilst I've seen them be generally supportive, you've got to really drag the money out of them, right? And if you're trying to raise 10, you might be able to get 7, or if you're trying to raise 5 even, you might get 3. And so that creates a real opportunity for venture debt to do what it's great at, which is fill out rounds, right? So if you're looking to raise capital in general, as always, venture debt can be a really, really useful way to fill out around where you've got that driver, i.e. you've got commitment from VC capital, right?
Mm-hmm.
So I think venture debt now has a great role to play. But again, it's all about the existing relationships and, as has been said, meeting the standards, right? But if you can get it, now it's going to be a great time to use it as a tool. And I have seen it used in that way, like it certainly is happening.
Yeah. Do you think it's advisable for startups to take on venture debt to make acquisitions, or just maybe as a bridge to profitability?
Yeah, sorry, I was going to say one. Yeah, not so much for that, I guess, although you could do that if the opportunity is there. Although I don't know what the venture debt guys think about using capital for that purpose. So throw it to them. But
I think that's,
the other thing I would say, sorry, I just said what I want to. Just with the valuations going down, but that's another good reason for venture debt can be a useful tool if you've got access to it, right? Because if you're raising money on a down round or a flat round or below what you think your company's worth in normal times, as always, right, venture debt gives you less dilution because less of the funds are tied to the giving away of equity. Now, when times are good and you're raising at a high valuation and your dilution is lower, that's still useful, but it's much more useful now when you're doing priced rounds that are hitting you quite hard and taking a lot of equity. If you can do a venture debt where it's repayable over 3 years and you're giving away like 2% in warrants, if that, again, right, there's a lot of drivers which make venture debt a useful tool. Sorry, that was all I wanted to say.
No, I agree. I thought you were talking about the providers as well. So I agree with what you're saying. And I think the biggest competitor for venture debt in India and even Southeast Asia, for that matter, I would say, is not the bank market, is not the bond market, it's cheap equity, right? So when equity starts getting cheaper, for founders, it's more about, do I want to invest the bandwidth and time and, get this product? Or if I can just, valuations and everything increasing and it doesn't feel like it's pinching me a lot, so might as well just raise a larger equity round and be done with it, right? So we saw a couple of those microcycles in India as well, when there's a rush of equity and it starts to look easy, then actually kind of tone down a little bit on the venture debt side for many reasons. And in the rising tide, all boats go up. So when there's a rush of equity, it's also difficult to figure out which companies are truly differentiated and strong and which ones are just, temporarily benefiting from the macro and in themselves are not maybe as fundamentally strong. So in tougher times, I think the distinction becomes starker and kind of easier in that sense. So today, to your question, Christy, be it for acquisitions, be it for burn, be it for working capital, at the end of the day, we don't restrict end use. We try to understand what the use of the capital is going to be. It needs to make sense from a broader underwriting construct. Is it safe? Is it relevant? Is it appropriate? Are the returns making sense? And is the company at the right stage? And can it absorb this kind of leverage? Now, what it uses the capital is that's part of the equation. And Chen and I both, we've done many of these deals in the past where it's been used for many different purposes. The key is to understand it upfront and a little bit of customization, but I would say broadly it comes down to testing whether the company is appropriate for taking a slice of venture debt, which comes down to first principles.
Sorry. Okay. Sorry, I thought someone was going to jump in. Yeah, how differently do you think, maybe Chen, you can take this one. How differently do venture debt firms actually assess companies compared to VCs, or do you consider yourselves to be, pretty more or less the same? And in terms of analyzing and assessing, managing risk in your portfolios, how does this actually influence the way that you guys pick your investments?
So I guess to answer the first question would be, I think we look at deals, I would say almost complete, like two different ends of the spectrum from VCs. I think, VCs are looking for the next, deal that can give them the 100x returns. And if the deal goes to zero, that's just part of the risks that they undertake. I think from the venture debt side, we're looking at it from the completely opposite side, is almost minimizing the downside. So we're not trying to optimize upside, we're trying to minimize downside. So when we look at our model, most of our, income comes from sort of interest and fees from the loans that we provide. So, one bad deal out of 10 really ruins it for the other 9, right? So it's like we sort of focus a lot on sort of that kind of thinking in terms of we have to minimize our losses. We're not trying to maximize upside or take oversized risks. So I always tell people that we're not in the business of sort of taking equity risks for the kind of returns that we get. It just doesn't make sense from a business standpoint. So I think that's sort of very different of how we look at companies. How do we manage risk? I think we're always trying to find, when we evaluate companies, what's the chance, we want to increase the chance of repayment, right? How are we going to get this loan repaid? Where's the repayment source? And all of our analysis sort of goes around that sort of thesis. In terms of evaluation, I think we look at it in some respects like a VC, in other respects sort of more like a traditional financial institution. So, we'll look at, we want strong founding teams. We want, good, competitive advantages on the VC. And so when we look at companies, probably similar to how the VCs would look at competitive advantage, what's the market size, how's the team? Where I think we differ is we look a little bit more from the financial point of view. We're going to look at runway. We're going to look at quality of the equity that's in the company. We're going to look at, just various, factors along those fronts. And so we put all that together to sort of come up with, okay, this is the kind of company that we would want to get involved with. But I think fundamentally we look at it very differently than the VCs do.
Yeah, to just add to that, I think I keep telling this to founders a lot, that there's 2 probabilities that founders kind of think about. There's probability of survival and probability of growth. I think for a venture equity investor, the probability of growth matters a lot. For a founder, it's both survival and growth. For a venture debt provider, it's survival at the heart of it. But you can't have growth without survival. So you need to live, you need to continue to survive, and then you kind of go on a path to growth. But for an equity investor, if companies die or they kind of meander along, it's the same, because they're looking for the one or two big wins, which will compensate for all the other companies. From our perspective, it's very different. And across 100 situations, you can hardly have a few which kind of don't perform largely to plan. And that plays a huge role in how we kind of evaluate the short to medium term. We're not looking at 7-10 year bets, which may give you 10-20x, because they can go through massive troughs. So there are many companies that are excellent equity bets because they go through fairly binary situations in the first 6 to 18 months. And if they come out of it, they can be really successful and create a lot of value. But those are not good for debt because this needs a more consistent path. And there are obligations on servicing the debt and so on periodically, be it monthly or quarterly. So it's not that every venture equity deal is a good candidate for venture debt. It's a fairly small subset of that.
Just sticking with you, Vinod, how does Alteria Capital go about pricing risk? I mean, my understanding is that for a lot of traditional banks, they do a lot of asset-backed lending, but a lot of venture startups, especially in the tech space, have very few assets. How do you guys go about pricing the risk on a particular startup then?
Yeah, and especially keeping in mind not only are there no assets, there's no profitability as well. So we've been doing this for about 12-13 years now. Before that, and I was in a large bank where you just look at operating cash flows, you just look at tangible assets, you look at net worth, you look at who's behind the company, and you provide them capital. For startups, none of these things apply. And these are young professionals who typically go on to start companies. They don't bring a lot of money necessarily. It's funded by venture capital. There's no profitability and there's no assets. So I think what we look for is what is the enterprise value and what is the attractiveness of a company in the short to medium term that it can raise another round of capital. This is what Chin was alluding to earlier. So while equity investors look at the market and the founders and the team, the position within the industry, for us, those are hygiene factors. So if those are not good, it doesn't stack up for sure. But just because those are good doesn't make it a good deal for venture debt. There is another layer over and above that, which is what is the attractiveness of the syndicate, of the capital sources that are available around the company. The question really is, if a company does everything it's supposed to do over the 9, 12, 15-month period, will it be able to attract capital at some price, in some form, in that period? Because if whatever we tell ourselves, like equity investors have a longer time frame. For us, if they don't raise the round of capital, they have a problem. So our underwriting is more tuned towards short to medium term. What are the levers of failure? Or I keep joking with some of the founders that I can't tell you which companies will do really, really well in India after 5 years, but we have a good handle on which companies may actually end up not doing well in the next 12 months. And we keep avoiding those or try to avoid those because we don't have the payoffs for that. If a company does well, the founders benefit, the investors benefit. We get a little bit of upside. But if a company dies, then there's a fair bit of loss, including us. So the payoffs are a bit skewed. We are taking risk. We are comfortable taking that risk, but it should not be equity risk. And there's a kind of waterfall of what is expected from founders and from equity investors, and then debt providers come into play. So we look at what is the ability of the business to last, what is the residual enterprise value, what kind of cover you want to have against that, what kind of cover you want to have against the capital coming in, who are the providers of capital, and it's specific individuals. It's not just the fund. Different people operate differently. A lot of what we do isn't about what's put on paper, but it's about relationships built over time. And we believe, there's a fair bit of transparency. And when somebody tells you something, you kind of accept it at face value at times. So who says that becomes important, and what you've done with them becomes important across founders as well. So even with follow-ons, with founders, that's why I said it's frictionless. So it's many different variables. It's more an art than a science. I think we try and templatize it. Chin and I've been trying to do it for a long time to try and templatize it to make it more, standardized. But at the heart of it, there's a fair bit of discretion. There's a fair bit of judgment. And there is a very strong relationship quotient which kind of cuts both ways.
Okay, last question for Chris before we move into our Q&A segment. Again, I mean, you've done a lot of venture debt deals. I mean, are there any big misconceptions that you've found founders have when it comes to taking venture debt? Any myths or blind spots?
Actually, not really.
Oh.
And this is not to blow smoke up the people on the call, but I think by the time they come to us with their term sheet, it's been explained to them pretty clearly by the venture debt guys, and they've done their own research. So I'm not having people come to me who don't understand the concept of venture debt or what a warrant is, or the implications of paying the money back. People at a high level understand it perfectly well. My job is more just working through the fact there's going to be a lot more documents than they're going to expect, right? Because there's the security deed, and there's the offer letter, and then there's the the loan documentation, and you've got to fulfill the conditions. And venture debt's always a bit of an annoying one from a compliance perspective, because it's debt and there's equity. So wherever you've got compliance obligations under law and under your governing documents for either issuance of equity or taking on debt, there's often a lot of resolutions and consents and stuff required from existing investors and shareholders. But that's all details, right? At a high level, people have got a pretty good handle on it, and/or it's been explained to them well via the draft offer letter and the venture debt providers, I think.
Okay, cool. So you're right on the dot. We're going to start tackling some of these Q&A questions that we have. I'm going to start off by touching on one particular question from a DSA subscriber from PwC Myanmar. I don't know how to pronounce your name, Sai Kyo, I believe that's how it's pronounced. The question is for Chin from InnoVen. It's how are you managing your portfolio companies if you found that they are unable to hit the next fundraising or operational milestone due to this crisis? I'm imagining like loan extensions, any of that sort. Have you seen, how do you plan to respond to that?
So I think we've been dealing with that sort of probably across all of our, 80% of our portfolio company in the last couple of months. Just dealing and speaking with founders on, what's the impact of COVID on the business. And, as I've told people before they even take on venture debt, I think, you're looking for a partner who's, venture debt partner who's going to sort of not freak out during stressful time and try to work with the company. So I think that's what we've been doing is we've been having honest conversations with founders in terms of, okay, what is this? What does the impact look like? Why is, I guess, what is your worst case scenario? So we start those conversations with founders. I think the last thing we want to do in these times is sort of, okay, if the company can't pay, force them to find a way to pay. I think that one's tough for us because we would lose everything in that sense. So I think, we work with companies, we work with their investor base as well to figure out, what's the best path forward. So I don't think it's a one size fits all solution. I think it really is individual discussions with individual companies on how can we sort of find a path forward. And so if that means we need to restructure our loan a bit, then, we will take that in consideration. And in most cases, we've been able to help most of the companies that have been pretty badly affected through the COVID situation, just because I think that helps us, but we can't, unfortunately we can't help everyone. Our fundamental business is the lending business, and our income is sort of interest and fee income. If we were to sort of just say, okay, we're not going to get paid for 12 months, we would be out of business, right? So we try to help where we can, and we try to be supportive, but there are limits to what we can do. So what I talked about earlier is really about sort of a collective effort to help the startups, right? So first, the companies are doing their part, we will help do our part, but then, also the equity investors will also need to sort of join that conversation and support, not just morally, but also financially.
You said you had like 24 companies in your portfolio, correct?
No, we have 40 plus now in the Southeast Asian portfolio, and I would say 80%, over 80%, probably 80% probably has, have had some negative impact. And it's been interesting to see just, and I wouldn't say interesting, it's been how far-reaching this has had an effect. I mean, it's not just on travel companies, for example. It's on a lot of the B2B companies who have corporate customers who are now saying, listen, I can't pay. So the companies themselves are having their accounts receivable be dragged out quite significantly. So that's causing cash flow issues for even companies you would think are have no direct relation to the COVID side of things. So I think it's been surprising how wide this I guess COVID has had an impact on all of our companies.
Okay. Have all 80% actually asked for loan extensions or no?
I think we've had conversations with at least 80% of the portfolio companies. I mean, and we try to help where we can, but as I said before, it's difficult to do help every single one as much as we would want to.
But typically, as a venture debt fund, like how much leeway do you set aside as a fund for for bandwidth, just to have wider bandwidth for situations like this? Maybe if Vinod, you can take this one.
Yeah, I think the normal assumptions around expected losses are quite different, right? So you expect losses of maybe 3 to 5% across the entire fund in a normal situation. The current situation is clearly much more extreme, and I think we're seeing similar conversations. We've spoken to maybe everybody we've spoken to, and maybe 60 to 80% of our portfolio is impacted in some form. And a subset of that is where we are trying to help them with some relief. And in India, there's the other aspect that the Reserve Bank of India came out and announced a 3-month deferment or a moratorium for the broader financial institution community. So obviously that increases expectations from founders as to what may be relevant for them. So we're taking it on a case-by-case basis. Our point is similar to Chin, where at the end of the day, while I'd love to help everybody, if we do that, then we shut shop, because as a fund, we don't get any relief or backstop, and it becomes a bit tricky. On the other side, there's a high level of empathy that founders are going through a really, really tough time, and there are some which are hit far worse than others. So we're trying to help them out. The more vulnerable companies need more time to figure out, what their path is. Those who just raise money, those who are sitting on some liquidity, we've encouraged them to not take the deferment, and they've responded. So I think over the last 4 weeks, one thing that's come through is predominantly the founders have understood that there's difficulty for everybody, and those who haven't needed the deferment or support, I think I've said, we will continue because we're quite fine and we have the liquidity to do so. I think the expectation on loss is going to get unraveled over a period of time. I think the next quarter would be a little bit more of an indication on behavior, on the revenue ramp, what is happening to different kinds of companies and what kind of revenue rates they see. It's going to take at least a year to really understand, what is the fundamental issue that businesses are going to face. At this point of time, I was chatting earlier also, right? There are some sectors which are definitely more impacted in our portfolio. Maybe dumb luck, we've not been exposed to some of that. I don't think there was any major recognition of this earlier, but it just sometimes you find yourself not in those buckets. That's just coincidence, but it's helping us a little bit. So I think it's going to take some time for the real recognition of loss here, maybe even a year. The idea is to ensure companies don't just fall off a cliff, and you work with them, handle them to the extent you can, and try and for everybody around the table recover as much value as possible. Make it more constructive. I keep telling founders as well that as long as people believe you're part of the solution and not part of the problem, they embrace you and they kind of try to take care of you. And it's worked well in the past for us as well. That's the approach we take.
Okay. Next question is for Chin by a person called Devin Patel from Altus Capital. His question is, what are the critical metrics debt funds like yourself are looking for? Time to revenue, equity cushion, convertibility, valuation sector?
So I think key issues for us, when I look at companies, I'm trying to boil it down to something simple. I don't think there's really any, financial metrics per se that we would look at. It really depends industry sector by industry sector. So I think a lot of our analysis really will focus on sort of existing cash runway would be one. What's the equity base look like? Who are the investor syndicates behind the team? We'd also want to look at sort of, the founding team. I echo what Vinod just said. I think in the past month or two, we've had a better, understanding of how founders are behaving in these circumstances. And for the vast majority of them, it's been great in terms of working with them, trying to figure out a solution. And unfortunately, there's always a few that are more difficult than others in terms of expectations. And so we've had, I think there's been a good feeling out process there. So I do think it comes back to a lot of it's the founding team as well, and how strong they are, and how well we could work with them. I don't think there's really any particular financial metrics that I would look at in particular. I think for us, it's really more of the softer, I would say just relationships that we want to build. Typically what we would do is, when equity rounds are done, we would typically do, anywhere from 20-25% of that equity round as a venture debt facility. I don't think that has changed much during this time. If we were going to put money to work, I think we use similar metrics there. Runway, we've always wanted, sufficient runway, and that really varies from company to company, sector to sector. But, in this time, I think that runway calculation is pretty difficult. And so what we're looking at probably, as a fast rule, I wouldn't say in this time, is that the company should have raised, equity either concurrently with what we're going to be providing, or have raised some equity in the last few months. Otherwise, it would be a more difficult discussion, I think, because runway is very difficult to calculate, just given we don't know what revenue is going to look like in the next 6 to 12 months.
This question is for Vinod and Chin. You did touch a bit about deployment strategy this year, but what would you say would be your worst case scenario if COVID does extend its stay much longer than expected? Vinod, you want to take this first?
Yeah, I think yeah, sure. So I think the same question we ask our founders, our investors ask us as well, right? Which is, what are your various sensitized scenarios? I think it's safe to say that the next 3 months, we're going to see fewer situations where we look at, fresh checks to new companies, where we won't start something from scratch right now. The idea is to first ascertain what the level of impact is. It's tough to forecast, but right now it looks like this quarter will go into just understanding that, April, May, June. And July through September is when we'd expect newer deal situations to emerge. I think there's definitely going to be a parallel track of existing portfolio companies where it's already visible that many of them are raising capital. There's conversations that are getting crystallized. So given that we have about 25 companies and with a few more, it's about almost 30 companies, that gives us a base where there's relationships and there's fresh opportunities to deploy into. But Christy, at the end of the day, I think the approach right now is to look at mitigating risk. I don't think we are thinking a lot about where, there's obviously going to be a need for capital. It's very visible, and capital is going to be at a premium. But that's for maybe 4 to 6 months out. I think for the next 2-3 months, it's just going to be hunker down, try and help the portfolio, follow through the conversations, which are already in play, and take them through to closure. Going to honor all the commitments that we made to founders at this point of time. So we're focusing on these 2 or 3 points for now, and wait for some variables to emerge on, what are the re-rating for different industries, different companies. And see, we have the dry powder, so that's not the issue. We can recycle capital. From our fund perspective, we've already deployed about 90% of the fund, but we can recycle capital. So we have the ability to fund through another $100 million in the next 12 months, but there's no rush, clearly. So the idea is to just wait for the right opportunities to emerge. Like I keep telling my team, the risk needs to be a complete no-brainer. It's okay if we don't get the returns that we normally desire, but the focus has to be on risk mitigation.
Chin, what's the worst case scenario in Southeast Asia?
I think we're going to, worst case would be, we would probably not do any deals in the next 6 months, is probably worst case, and then hope to look at Q4 this year to deploy, is sort of a worst case for us.
Okay. Another question about DDs. How do you guys do due diligence at this time, especially with the travel restrictions?
On Zoom. So a lot of that happens online. I think we are, at least a lot of the work happens through, phone and mail. And that's another reason it's a little bit trickier with new relationships. They're not able to meet people. personally, I mean, I'm getting coming to terms with that, and it's an evolving point for all of us. But also a reason why existing portfolio kind of gets an advantage because there are relationships and you're already familiar with the data.
Yeah, I think we're just getting used to doing a lot of things by conference calls, by Zoom. The good thing for us is a lot of our due diligence will be speaking with sort of investors of the company, and so we've already have pre-existing relationships with almost all of those investors, and so it's an easy call for us to make, and so there's familiarity there. So it really is trying to get comfortable with the founding team and not being able to meet them in person, not being able to go to their office. I think those are issues, but I think less issues for us as compared to probably the VCs who really want to kick the tires a little bit more. So I think that's been the challenge for a lot of the companies that we've been dealing with, is that the VCs have been able to sort of complete their due diligence and then not be able to sort of fund. And then that sort of slows things down on our side because we're sort of waiting for that to happen.
In fact, it's easier to catch hold of people these days.
That's true.
Okay, next question. Sorry, you have so many questions coming in. Our next question is, what are your LPs saying about venture debt opportunities? I'm just wondering if you can start with Chris first. I don't know I'm sure you've spoken with
No, it's okay. It's definitely one for the other guys. Everyone wants to ask questions to the guys with the cash, so I'm not talking to the lawyer. I'm not offended. I don't deal with the LPs, so I'll hand it over.
Okay.
So I think for both Chen and myself, the nature of LP base is different. So for us, it's a lot more fragmented. We have a few large institutional investors, and we have a lot of family offices, largely from India. So over the last 3 weeks, we've been kind of helping them understand, the first question is, what is your expectation? And the answer is, we need some time. Right? So I don't think it's feasible to give an answer which is very clear right now. So we are, from our perspective, we kind of cut the portfolio across various parameters and help people understand, this is how we're looking at our portfolio today, and it could change. And it could change every week, it could change every month, and it is going to change. The good part is this is a dislocated asset class. If you look at India, the listed markets have dropped by maybe 30% in the last couple of months. And this has no correlation with that. So whatever happens in the public markets, rates have been cut sharply. Bond yields have gone to different places. So none of that has any impact on the downstream venture debt portfolio. For us, what's most important is the health of the companies and the health of venture capital or venture equity as an industry. The latter I'm feeling quite confident about as far as India is concerned. But to educate the LPs, I think it's been a process. There is a fair bit of understanding, but there's a lot of questions.
What about you?
So we're not a fund structure. So we have two large shareholders who have committed capital to the InnoVen platform. We don't have to deal with sort of, I guess, in the traditional fund LP sense of having capital commitments and then going out and raising a new fund, for example. So not much experience there. My only comment would be that I think for LPs who haven't committed to the venture debt asset class, I think there'll just be more questions asked about what kind of returns can you expect, challenge assumptions on default rates, challenge assumptions on various things. I think there's just going to be more questions from LPs on the attractiveness and how are people managing venture debt funds these days.
Next question is also for Chin. We've got frontier markets like Cambodia, Laos, Myanmar, Vietnam, which have more nascent banking systems and cross-border interoperability. To what extent do venture debt firms see moving into these nascent markets as a first mover opportunity? Would players like yourself be willing to take on the burden of assessing the legal frameworks and banking structures? So
we've been quite, I guess, open to that idea, and I think we continue to be. I think the COVID's put a little bit of a damper on sort of expansion into new geographies. We've been in Vietnam for almost 2 years now, and looking at that market. The only comment I would make is that venture debt in general sort of usually requires a pretty consistent and sort of well-established sort of venture capital industry. And so if the venture capital industry itself in those countries aren't very established, it's very difficult for me as a venture debt firm to also just to go there on our own. So I think that that's the challenge in those kind of markets, is that while we do have, one deal in Myanmar, for example, and 2 deals in Vietnam, it's, those are probably more because of the investor groups that we know, and then, they sort of wanted us to take a look at those. So I think that's how we would sort of approach those markets in the first place, is sort of through, strong investor groups wanting us to take a look. I mean, we're open to it, but I think COVID has sort of put us a damper on sort of new geographical expansion at the moment. But, when things get back to normal, I think, we're definitely looking at those markets.
Okay, we have another question from an attendee. What about a company with decent cash flow that needs working capital for growth, but is not able to raise funding due to a lack of tangible security? The firm has only raised a small angel round. Would such a company be eligible for venture debt funding?
So from our perspective, we've laid out some guardrails on the nature of companies we would fund. And we have consciously excluded pre-Series A companies at this point of time for multiple reasons. One is, while some of these situations may in fact look less risky compared to later stage, Series B, Series C companies, even which are high burn, it's a different kind of risk. It needs a different approach to underwriting. And it's tough to blend the two, because our stated strength has been, the kind of relationship we've developed over a period of time and understanding the venture capital environment, understanding venture capital trends. So which is why, ironically, you could have a profitable technology company which is bootstrapped, which, logically should be lower risk, but falls outside our purview at least, because we've said that we'll look at venture-backed companies and play within that ecosystem in terms of our target market.
Okay, we've come close to the end, so we're going to take one last question. This is from Fiona Cho from Ikala. This is for Vinod. The question is, how significant is the venture debt route at this juncture for startups that are targeting to raise Series B or C rounds?
I think it could be a very strong mix for Series Bs and Cs in terms of size. So we typically do between 15 and 25% of rounds. And especially when valuation is under pressure, if you're trying to raise a $25 million round or $25 million of capital, if $5 million can be substituted through non-dilutive debt, then that packs a punch for the founders, especially if valuation is dropped by 15, 20, 25%. The second thing it does is the nature of the round. If you're quickly raise 20 million, you get one lead, you get your pro rata from existing investors, and you get some debt, the home, versus trying to get 2 leads, or in some cases 3 leads, where the process can take longer, and it can in fact derail the entire funding round itself sometimes if things don't come together. So from a process efficiency, from kind of packing a punch and saving dilution for founders, it can help. The allied question is, unfortunately, the debt cannot precede the equity. So sometimes founders are, I'm almost there with the round, but can the debt come ahead of the round, which unfortunately, can't happen, because that becomes a bridge and that gets far more risky. But it can definitely be productive for founders who are trying to raise, Series Bs and Cs. Good amounts of debt can be used.
Okay, we have come to the end of the webinar. Thank you so much for joining us today. Once again, this was Chin from InnoVen, Vinod from Alteria Capital, as well as Chris Wilson from Simmonds Stewart. Thank you so much for joining us.